The 10-year U.S. Treasury yield rose above 3% for the first time since January 2014, in a signal that higher interest rates are ahead in the world's biggest bond market amid an onslaught of supply and a Federal Reserve intent on boosting interest rates. The yield, the benchmark for everything from U.S. mortgages to dollar bonds in developing nations, climbed as high as 3.0014% on Tuesday, before retreating to 2.99% as of 11:36 a.m. Traders have been focused on the next round number on the horizon for days, even though no clear catalyst emerged as the main culprit for the longest sell-off in a year. The move reinforces that yields are on the rise in the $14.9 trillion Treasuries market. They surged in the first 2 months of the year, but paired that advance last month, leading some strategists to ponder whether 2018 might echo 2017, when optimism on the economy led yields to peak early in the year. Fed officials' most recent forecasts are for 2 additional rate increases in 2018. Traders are pricing in more than that. "We are basically at our mid-year target right now," said Jay Berry, a JP Morgan Chase fixed income strategist. "This yield move is to be expected now given we are at a mature point in the cycle. Of course, just because the market hit a milestone doesn't mean investors need to fret about runaway interest rates just yet." JP Morgan estimates the 10-year yield will end 2018 at 3.15%, the same as the median forecast of 56 analysts surveyed by Bloomberg. Indeed, the last time the 10-year yield topped 3%, toward the end of the bond market wipeout known as the taper tantrum, Treasuries went on to rally anew. This time, however, bond traders have to grapple with a deluge of new government debt. The U.S. budget deficit will surpass $1 trillion by 2020, 2 years sooner than previously estimated, the Congressional Budget Office said this month. At the same time, the Fed is trimming its balance sheet, meaning the amount of net new debt is poised to surge in the years ahead. Treasury has asked primary dealers to give forecasts for America's borrowing needs over the coming 3 fiscal years, ahead of the next quarterly refunding announcement on May 2. Just this week, the department is issuing a combined $96 billion of 2, 5 and 7-year notes, the largest slate of fixed-rate coupon sales since 2014. Yields on all the maturities are near multi-year highs. Some market observers, like Jim Bianco, president of Chicago-based Bianco Research, downplay the significance of 3%, blaming an infatuation with round numbers. At the same time, there's no question the 10-year yield is within striking distance of important technical levels, particularly 3.05%, he said. That's because 3.0516% is the intraday peak set on January 2, 2014. Any yield higher than that hasn't been observed since 2011. "We haven't been at a 7-year high in a long time," Bianco said in a telephone interview. And then people start thinking again about if we are in a multi-year bear market in bonds.